Wow, this is horrible strategy. For Apple, just buy and hold will work much better for you. Yes, I built my strategy and backtest it. The result sucks. Yeah, that's a life. Shift enter, enter, enter. SMA never works for Tesla. Don't use this strategy for Tesla. What's up, everyone? This is Dr. Tay from Quant. Welcome back to our beginner's guide to algorithmic quant trading. In our last episode, we successfully implemented our first simple SMA crossover strategy. Do you remember? And generated buy and sell signals as well. We even plotted those signals on the price chart, giving us a great visual understanding of when our strategy would enter and exit the trades. But seeing signals on a chart is just the first step, okay? The real question is, did this strategy actually make money for you? And how much? And how risky was it? Today, we are going to answer those questions by diving into backtesting basics. Boom, boom. So, what's backtesting? Backtesting is the process of applying our trading strategy to historical data to simulate its performance. It's like running a time machine to see how our strategy would have fared in the past. This is absolutely crucial before even considering using real money. So why is backtesting so important? First, quantifying the performance, risk assessment, strategy comparison, identifying flaws. So the first one, the quantifying the performance. It moves us beyond the look great on a chart to concrete numbers, profits, losses, and growth. So tackling cumulative profit and loss. Monitor cumulative profit and loss over time to visualize growth trajectory and identify steady gains or drawdowns. And analyzing growth, as I mentioned, assess growth patterns and consistency to understand the reliability and volatility of returns across market conditions. So second point was the risk assessment. There is always risk in trading or in our lives, right? It helps us understand the potential downsides, like how much capital we might lose during market downturns. So we gotta identify, estimate the maximum capital, and evaluate the volatility and risk-adjusted returns. Those are very difficult terms, some of you guys, but I'll just skip it through. So next one is a strategy comparison. You can have a ton of strategies. Each quant has their own strategies, right? So you can always cherry pick and pick the better ones for you. It provides a standardized way to compare different strategies against a benchmark like buy and hold. If you buy Apple and just hold it forever. And if you want to implement your strategy like SMA crossovers, you can compare with that buy and hold as a benchmark, right? And then we can compare our strategy actually works or not. So yeah, and the identifying flaws, it helps us spot periods where our strategy struggled, allowing us to refine or discard it. So basically, it's very vital to remember past performance. Write that down. Past performance is not indicative of future results. Gotta remember, past is past and it's random walk in the market, right? But a strategy that consistently performs well across various historical market conditions has a better chance, better opportunities of performing well in the future. That's another hypothesis, right? Let's head back to our Colab notebook. We will pick up right where we left off with our Apple data frame containing the close price, 20, 50 days of SMA, signals and positions columns. So I'm going to move here. So as I shared before, this Jupyter notebook or the Colab notebook will be provided in the link below, okay? Just find it out, and if you can't find it, just let me know on the comments, please. So episode 5, I wrote those codes, or you can rerun the previous episode's codes so that you can just catch up quickly. So here, you should read this. You should be able to read these, right? Ticker Apple from 2020 to 23, or I can change this to, let's say, July 25th. And Apple close 2050s, and I'm gonna hit Shift Enter, the most important shortcut. Shift Enter. You rerun those. and you see the price and the actual signals and positions. 0 versus 1. 0 versus 1, right? You see the signals here. So from now on, we are going to calculate daily returns and all other different terms, okay? First, we need to know the daily percentage change of the asset's price, Apple's stock price. This is very straightforward with the pandas. Panda will work for you. .pct underbar change method, as you see here. Okay. So we define daily return equals the close price dot pct underbar change, and then we'll see how it shows us. There we go. It automatically calculates it. So let's move on to the calculate strategy returns. This is the core of our backtesting, okay? We want to see the return generated only when our strategy was in a position. We'll assume a long only strategy this time, meaning we only make money when the price goes up. We don't care about the short, the going down. So we only care about long only. We are holding the stock. If our signal column is 1, indicating a long position, we apply the daily return. If 0, our return for that day is 0. Common approach to multiply the daily return by the previous day's signals. This simulates entering the trade at the close of the current day based on the signal determined by the today's data and then making money on the next day's price movement, or entering at the open of the next day. This avoids look ahead bias. You don't need to go outside and get the stock. Just wait until it comes to you, okay? So this avoids look ahead bias, where you assume you could trade on information before it was truly available. That's a big tip for you. All quants are still having those kind of easy bias. So gotta be cautious about it. So I wrote the code already for you. So calculate strategy returns. Apple strategy daily return we define equals daily return times signal dot shift 1, and drop NaN data, null data here, and replace them. These are just Python grammar, so you could just follow with me. Now you see those results. Daily returns are minus, minus, negative, negative, and you see the negative returns here. So we're going to move on to calculate the cumulative returns. Daily returns are useful, but to see the overall growth of our hypothetical portfolio, we need to calculate cumulative returns. This shows how an initial investment, let's say just $1, would have grown over time. We do this by taking the cumulative product of 1 plus daily returns. So here, cumulative strategy returns equal 1 plus something dot comprod. This is another method in Python. So Apple cumulative buy and hold returns we define as 1 plus daily return comprod. You see the difference? Can you compare these two? So we use strategy daily returns cumulative versus daily return columns, the cumulative returns. And then we see the Apple dot tail and check the last few rows to see the cumulative returns here, as it says. Now you see these. But, we got to visualize it, definitely. So I wrote the code for you, and let's run it. This is Apple. The orange or yellowish line is buy and hold returns versus our SMA Crossover strategy returns is under purple color. Wow, this is horrible strategy. For Apple, just buy and hold will work much better for you. That's interesting, right? This is the fun part. Yes, I build my strategy and backtest it. The result sucks. Yeah, that's a life. So that's amazing. I mean, we can do, let's say Tesla maybe, or McDonald's. Let's go McDonald's. If I change the stock here, my ticker as MCD, shift enter, 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 shift enter. There we go. For McDonald's, if you buy and hold, certain period, SMA works better. However, still in long term, in like 5 years, buy and hold is the king. That's interesting. What about Tesla maybe? Let's do it. TSLA. Shift enter, enter, enter. There we go. SMA never works for Tesla. Don't use this strategy for Tesla. But you see the big swings, top and bottom here. Top and bottom. That was backtesting, by the way. I hope you enjoyed this video. Well, I can give you some homework, but just keep in mind, do your own strategies and try the stocks that you love and to see how it will work. Okay. So you've now taken a huge step from just identifying signals to actually simulating the performance of a trading strategy. This is fundamental to becoming a quant trader. If you have any questions, leave them in the comments below. Don't forget to like this video, subscribe to Quant's channel, and hit the notification bell so you don't miss our next episode where we will quantify our strategies, performance with key metrics next time. So this is Dr. Tay from Quant signing off. Peace. Happy backtesting. Bye-bye.